Hello, I'm Peter Herbert. Welcome to the latest in our series of short webinars looking at topical aspects of financial reporting, auditing, and company law. And today we're going to focus on a topic we covered in previous sessions, which we get lots of questions on, which is the disclosure requirements for small entities of FRS 102, Section 1A. Here's the running order. So we'll start with a very quick overview of the requirements and then look fundamentally at four areas. Section 413 of the Companies Act, so that's advances, credits and guarantees, if you like, overdrawn direct loan account disclosures. We'll look at related party transaction disclosures, creditor disclosures, and disclosures in respect of accounting policies. And we'll use some specific practical examples to try and draw through the key themes, the key points. Okay, let's start off with that overview then. This slide gives a summary of what Section 1A of FRS 102 requires. Remember that 1A accounts are required to give a true and fair view. Remember that under Section 1A, you're allowed to do things like abridge and adapt balance sheets and profit and loss accounts. That's not really the focus on today's session. We're going to focus more on detailed disclosure. And yes, the requirements for disclosure in this area are embedded within Appendix C of Section 1A. The Financial Reporting Council also recommends additional disclosures to inform a true and fair view specifically. Historically, they have been embedded within Appendix C of D, I beg your pardon, of 1A, but for periods commencing 1 Jan 19, since the FRS 102 triennial amendments, those recommended disclosures are now embedded within Appendix E. And here is a summary of the mandatory disclosures in Appendix C. There are sort of 13 broad areas. Now, there'll be more specific detailed disclosures than 13 because each area has got a number of different facets to it, but 13 broad areas. And remember that to the extent that the disclosure does not actually relate to the profit and loss account, any notes will need to go into the filed accounts at Companies House as well as going into the shareholder accounts. I guess the one that very often will be excluded from the filed accounts will be any exceptional item disclosures, because of course exceptional item disclosures do relate specifically to the profit and loss account. Okay, let's look at our first area then, which is the area of Section 413, advances, credits and guarantees. Now, I think advances, credits and guarantees, overdrawn direct loan accounts, if you will, and related party transaction disclosure requirements are very closely linked because they are, of course, all to do with transactions with parties who are related to the reporting entity. But I'm going to look at them individually here, starting off with the advances, credits and guarantee disclosures. And again, you've got a summary on the left there of the fundamental requirements in relation to advances. So information about the amount, indication of the interest rate, main conditions, amounts repaid, amounts written off, and amounts waived. And of course, this will be a requirement for any company, large, medium, small, or micro. Okay, here's an example of the sort of thing that we see a lot of the time. And I think the way the notes kind of tend to get produced by accounts production software, they do tend to be very often, I think, tabular in nature. Now, what's going on here basically is the company started off with a credit balance on the loan account. Amounts have then been advanced to make the loan account go overdrawn. Amounts then have been repaid. And then at the end of the year, we've got a 7973 balance, which again is a credit balance. I think in terms of the tabular presentation, lots of accounting production software does sort of push you towards that sort of tabular presentation. It's not specifically required because, again, going back to the previous slide, what do we say? You disclose amounts, indication of interest rate, main conditions, amounts repaid, amounts written off, and amounts waived. There's no specific requirement there to incorporate that within a table. There's no requirement to disclose specifically the total amount outstanding at the start of the year or at the end of the year, not least if those are creditor positions. The other one which people often ask us about, of course, is are you required to disclose the maximum amount overdrawn at any one point in time during the year? And again, I think a lot of accounting production software does encourage that disclosure, but that is technically a throwback to the old Companies Act 85 disclosure requirements and not technically requirements of the legislation now, and therefore the rules within Section 1A. One other point, and this I think probably was poor drafting when the legislation was put together all those years ago, is that you are not technically required to disclose the name of the director to whom the advance has been made. I think lots of professional bodies encourage that, but that is technically not required. And I think certainly some accounts we see, there is good transparency about the name of the director concerned, other accounts less so, taking advantage of that sort of slight loophole really in the way that the legislation was drafted. So that's, if anything, typical of the sort of thing that we would see, but also, if anything, slightly more than is technically required. And going back to those fundamental requirements on the previous slide, what we're going to do on the next slide is probably show you what you could maybe get away with in terms of the disclosure, which would nonetheless be totally compliant with the legislation. And there it is. So if we assume that the opening balance was 14,103 credit, the amount of 8816 was then advanced. That would then mean that the advance was actually a net 74059. So we're given information about the advance. We're told that the advance was repaid, and we were given an indication of the interest rate and the terms and conditions. So that is much less detailed, but is totally compliant. We are in that situation, naming the director, because that I think probably is in the spirit of transparency, although as I mentioned, technically not required. Okay, let's then move on and have a look at related party transactions more generally. Let's go back to that earlier slide, and we're now looking at the right-hand side of that earlier slide. Yeah, I think with this one, I've always felt that you've got to look at it really in two ways, two aspects here. First of all, remember that under Section 1A of FRS 102, unlike the rules back in the day under the FRSI, you've only technically got to disclose transactions with three categories of related party. So when the entity transacts with a key shareholder that owns more than 20%, that transaction would require disclosure. When the entity transacts with an investee company in which it owns more than 20% of the shares, that requires disclosure. And when it transacts with a director, that requires a disclosure. Although, as you've already mentioned, where that transaction involves Section 413, the rules are a little bit different, and they, of course, covered away to the left on this slide. So in a way, first port of call, do we transact with one of the three? And if we do transact with one of the three, where the transaction is not concluded under normal market conditions, we are required to disclose. Where the transaction is concluded under normal market conditions, we're not. So I think it's looking at those two facets really. And what my observation has been since this regime came in back in 2016 for small companies is that I think related party transaction disclosures for small companies are very, very rare in reality, and I think much less prevalent than you get in a full FRS 102 set for a medium or large entity. Now here's an example of the sort of thing that we would typically see. So we've got at the top there information about a loan from Mr. O. Jones, company director. We've got information there about dividends being paid to the directors, and we're told that Mr. O. Jones is the company's controlling party. Let's just cover those off in turn. I mean, I think loans from directors to companies are very much related party transactions. And of course, because the transaction is involving the director, that would definitely be one of the three. I guess the question would be, is it a normal market conditions transaction? I mean, to me, an interest rate of 5.5% seems reasonable and probably would equate to a market rate. So for that reason, given it is a normal market conditions transaction, there's no law against putting these transactions into the disclosure notes, but that one I would say is one that you could probably get away without disclosing, given it actually meets that criteria around normal market conditions. Dividends paid to directors are again relevant transactions in that the company is transacting with the directors, and that again is very much going to be one of the three. I think the question with dividends has always been, dividends paid to directors, is are they normal market condition transactions? I think if it's something very unusual about a dividend, then you probably would say no, and you would therefore need to disclose that transaction. If everything seems fairly logical in terms of the dividend payment being made, then I think it would qualify as a normal conditions transaction, and therefore that would not need to go in. And of course, the other thing to bear in mind in terms of disclosure of dividends is if we do provide transparent disclosure in the notes to our affiliated accounts about dividends paid, given we can then, so as well as seeing the dividends paid, also get a sense of the movement in shareholders' funds from looking at the balance sheet, you can then, of course, with a little bit of accounting knowledge, work out what the profit is. And that would, of course, breach that thing called profit privacy, which basically says that from a small company filing point of view, you wouldn't ordinarily be able to work out the profit figure the company's made by virtue of looking at the financial statements that have been put on the public record. So that, again, I think really is a reason why, for many people, those dividends paid to directors transaction disclosures do tend to get omitted. And finally, on the third one there, we do see information about controlling parties all the time in notes of the account. You've only got to disclose the controlling party in a small entity world where that entity is a subsidiary entity being included in consolidated accounts, which, yes, if it's a small subsidiary in a medium or large group, would be relevant. For a standalone small company point of view, it would not be the case. And that, again, would be a disclosure that could drop out. Okay, let's move on to creditors. What I've got here, again, is a typical sort of creditors note that we would see in a set of accounts. There's a number, I suppose, of points to make here. And I think if anything with this one, would probably really, I suppose, reinforce the fact that in some senses, this is more detailed than really would be required. In terms of the small company accounting rules for disclosure and presentation of the balance sheet and the related notes, there are only technically 4 categories of creditor that you would need to disclose within a creditor's note, and they are bank loans and overdrafts, trade creditors, intragroup creditors, and other. So whilst it's absolutely fine to incorporate that level of detail, it's not a requirement, and it would be possible to be more sparing, I suppose, in that sense, in terms of the amount of information that does go into the note, which, again, remember, will be a note that will be filed on Companies House. Now, whether it's a big issue, I'm not too sure, but again, one of the points that's often made to me about filing more than you need to file in your creditor's note is if you incorporate information about your corporation tax charge. If the reader of the account has got a vague sense of what corporation tax rates are, they could take the corporation tax creditor, divide by the corporation tax rate, and then get a sense of the actual amount of profit that's been made. So that, again, of all those various aspects there, is probably the more sensitive one, and again, one that you would technically not need to incorporate within a small company creditor's note in any way, shape, or form. The other 2 points, I suppose, that are relevant here, we have got information about secured loans, and that, of course, is a requirement of the small company regime. It talks about the requirement to disclose the aggregate amount of creditors where security is provided, and indication of the nature and the form of security. I guess the one I'm mindful here is also in scope, is not only the bank loan, but also the finance lease creditor as well. So in a way, that security note does not incorporate the full amount of loans which are secured. The finance lease creditor should be in there as well. Remember as well, if there were amounts falling due in more than 5 years, they will also need to specifically be disclosed within the creditor's note. Don't forget as well, if you were to abridge your shareholder accounts, then the creditor's note would drop out, or the tabular note would drop out completely, and there would therefore be no analysis of creditors falling due within 1 year, either within the shareholder accounts or indeed on the public record. And I think abridging of shareholder accounts is not a massively common thing as far as I'm concerned. But again, if you're looking to go for very, very light touch disclosure and you want to lose that creditor's note completely, then abridging would be the way to go to make sure that that outcome is achieved. Okay, let's look lastly, if we could, at accounting policies. Yeah, my thing with accounting policies is getting a balance really between having enough information in there and making sure it's sufficiently detailed, but not overdoing it. And I think, I would say not too much, not too little. I think sometimes proprietary software, really does go to an extreme, putting loads and loads of information in, which is very, very unhelpful. So I think my tip is always don't be afraid to, I suppose, edit it down and weed out the stuff that's not relevant. And I guess looking at this particular example here, I mean, cash at bank and in hand, it can be an area where there might be a policy, there might be some judgment being brought to bear where possibly there are deposit accounts where you do need to give notice to actually get your hands on the money concerned. That is possibly discussion, debate whether that would indeed be cash at bank or whether that would be current asset investment. But I think where you're looking at a situation where a small entity has quite simply got an ordinary instant access deposit account and or a current account, there's no element of policy, there's no element of judgment there at all. And that, to my mind, that note could absolutely drop out and not be there within the accounting policies notes. The turnover one is an old chestnut, which I'm sure we've talked to you a lot about before on courses. My big thing with the turnover note is to be really clear as to exactly what the point of income recognition is. At what point is income recognised? And that particular note there, although a very common of the sort of notes that we do see, in no way, shape or form tells that story. Okay, so we've had a look at a number of different aspects of small company disclosures there. Just a few points to wrap up. So software often defaults to over disclosure for overdrawn DLAs. We saw that in the example. I talked a bit about the way we might possibly reshape that disclosure to make it compliant, but a little bit less detailed. The key question for related party transactions is, are the transactions concluded under normal market conditions? And if they are, there is no need to disclose. And as we saw in that example during the short session today, that would then mean probably less disclosure than we had there in our example. Don't forget the secured liability disclosure for creditors. I think that the finance, lease and HP creditors often gets missed out of that. So that's something which, again, although it's only an aggregate disclosure, would need to be included. And accounting policy notes, not too much, not too little. Again, I know that firms will do accounting production software, production on a big scale for small companies, and won't have hours to agonize over every sort of last letter, every last word. But I think often there is too much loaded in, which is not really involving any sort of policy or any sort of judgment. I think paring back can be helpful. It doesn't, I think, then make the notes of the accounts slightly more proportionate in size, and there's a better link, better balance between the amount of words and the amount of numbers. If that sort of filtering down is not really done, the accounting policy notes become very, very clunky. And from a readability point of view, that does not help, I don't think, the small company accounts in any way, shape or form to be useful to the reader. Okay, I hope that was useful. Do drop us a note at inquiries@insight-training.biz if you've got any questions about this session, and do check out our website for our full program of events for spring and summer 2021. In the meantime, hope that was useful. Great to speak to you all, and I'll speak to you all again soon. Thank you.